सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The big headline this Friday for people watching the economy is the Monetary Policy Committee meeting and its decision to increase rates. The debate has been 50 points or 25 or something in between. All of that would have been out on the news channels and on websites, and you would have tracked it very closely. And we thought we will not go into the MPC debate, but look at something which is much more intrinsic to the economy's health, and that is the foreign exchange reserves of India. This has been in the news lately for several weeks now because it has been shrinking or depleting. That is because the RBI has been selling dollars to keep the rupee steady at a certain level. And you know how the rupee has touched 80, touched 81, crossed 81, come almost close to 82. And then there are worries. Is the RBI doing too much by selling too many dollars and hurting India's foreign exchange reserve? That is the question we will tackle today in Macro Sutra. Hello and welcome. I'm YP Rajesh, Managing Editor at ThePrint, and I have Radhika Pandey from the NIPFP. Radhika, you have written in your column that the forex reserves fell for a 7th straight week and dropped to $545.6 billion. That's like almost a record low for 2 years. I think 2020 October it was lower than that. And from what my research found is that this is $85 billion down since February 25, which is the day after Russia invaded Ukraine. For our viewers who don't track forex so closely, why has it fallen by almost $100 billion this calendar year, $85 billion since the war started?
So this has been the fastest pace of depletion of foreign exchange reserves. So since the war, we've seen a decline in foreign exchange reserves, and this pace of depletion has picked up over the last 2-3 months. And that is primarily because the dollar has surged. The dollar index, which is the gauge of the strength of the dollar, that has increased in value, and that is due to the fact that the Federal Reserve of the US, the US Central Bank, has been aggressively pursuing rate hikes. So while we see across all central banks raising rates to tackle the red hot inflation, but the US Federal Reserve has been much more aggressive in raising rates. So when the pace of rate hike is much higher for US as compared to say Bank of England or say Australia, so we have a table in the article where we show that US Fed has increased by 300 basis points. The rates of interest have increased by 300 basis point, whereas India, RBI has increased by 140 basis point, Bank of England has increased by 150 basis points. So because of the aggressive rate hike, the dollar and dollar denominated assets have surged, have strengthened, and that has resulted in whenever dollar rises, the other currencies face depreciating pressure. So they face a downward pressure, which is what we are seeing for rupee as well as mostly all non-dollar currencies.
Some people have tried to compare this fall in the forex reserves to what happened during the taper tantrum in 2012-13, and before that the global financial crisis in 2008. Where do you put this episode vis-a-vis those two episodes?
So those two episodes also were characterized by a crisis situation where, particularly if you look at the taper tantrum episode, which was in 2013, August 2013, where the Federal Reserve chairman indicated that they will start tapering the dollar, they will start tapering the bond buying program. So just before the at the onset of global financial crisis, the central banks were pursuing ultra accommodative monetary policies. So the governor indicated that now is the time that they will start slowing down that ultra eased monetary policy. So as a result, just that indication, just that speech where they indicated that they will start withdrawing the stimulus or withdrawing the ultra accommodative monetary policy led to a huge outflow of FPI's foreign investments from emerging economies, including India. And that again led to rupee depreciation. And during that 3 months time, from July to September, we saw a huge depreciating pressure on the rupee. Rupee depreciated by almost 16% during that short span of time. And that time the strategy was not so much to intervene using foreign exchange reserves, and therefore that time we did not see a very sharp pace of decline in our foreign exchange reserves. So that is one element of comparison between the 2013 episode and this episode, that this time we have not seen much decline in rupee. So if we just compare rupee with some of the other currencies which have also faced depreciation, we see that rupee has been relatively stable. It has not seen that kind of sharp depreciation, and that is primarily because RBI has been intervening and selling dollars to prevent the slide of the rupee. That was not the case during taper tantrum episode. That time the main instrument was interest rate defense. That time the Reserve Bank of India raised rates aggressively. So that was the main instrument, whereas this time till now it has been using the forex, because we had, like October 2021, we had $621 billion of reserves, record high forex reserves. So we had the ammunition to use it for preventing the rupee slide. But now it's the question, how long should we do or not?
In fact, one of the comments I was reading today was, don't say that the rupee has fallen. The rupee has not fallen. The dollar has risen.
Yes.
So the strength of the rupee has not weakened.
Yes.
It is because of the dollar, and because even other currencies have depreciated vis-a-vis the dollar, whether it's the euro or the yen or the British pound. This worry about forex reserves, Radhika, is also about how much forex reserve is adequate or sufficient, and how do we measure it? We always hear about or read about it is enough for 6 months of imports, it's enough for 3 months of imports. Yesterday there was a report that Pakistan has forex reserves which is only enough for 1 month of imports, and recently when there was a crisis in Sri Lanka, we were talking about 15 days, 7 days, 10 days. Of course, India is not in that position, although in 1991 we know things were very bad. So can you explain how this is calculated in terms of what is adequate, what is not adequate?
So the International Monetary Fund has come up with some indicators to assess the adequacy of reserves. How do we measure whether the reserves which the country has, whether it is adequate or not? And these reserves and these adequacy indicators or metrics, as we may say, they vary across the type of country, whether you are a closed economy, whether you are an emerging market economy, or whether you are an advanced economy. But traditionally, there are 3 metrics to assess the reserves adequacy. The first is how much of your reserves can provide cover for imports. And for that, the thumb rule is that reserves should at least be adequate to cover 3 to 4 months of imports. That is the first indicator to assess the adequacy of reserves. Now, this was the oldest metric to assess the reserves adequacy, and this is basically true for those economies which are closed economies, which do not have very deep international financial linkages. Because if you have financial linkages, then if you have your imports are more, maybe your capital flows are sufficient to finance the imports, like what we have in India. We have a traditional current account deficit, but till now we were having a capital account surplus. So our foreign direct investment, FPIs were quite robust. So that is number one indicator, that in a closed economy, how your reserves should be sufficient enough to finance 3 to 4 months of imports, to pay for 3 to 4 months of imports if there is a crisis situation. The second indicator, which is more applicable for emerging economies like India, is whether your reserves are sufficient to cover short-term debt. short-term external debt, because external debt short-term here means maturity of 1 year or less.
Okay.
So if your reserves are sufficient to cover 100%, your reserves are providing 100% coverage for short-term external debt, then that means the reserves are sufficient. That is number 2 criteria. And number 3 is, what is the proportion of reserves to your money supply? This is a very new indicator, and this is being talked about a lot, particularly when we see a crisis arising due to outflow of deposits. Okay, so there can be 2 reasons for a crisis. Firstly, maybe the inflows dry up, or secondly, the outflows, the resident deposits are taking their money out. So if that is the case, that crisis is emerging from the outflow of resident deposits, to capture that kind of crisis situation, your reserve should be enough to cover 20% of your money supply.
Okay.
And here money supply means your currency and your deposits. So those are the 3 traditional metrics, while there are other metrics, but those are used even now and widely used to assess the adequacy of reserves.
In fact, Radhika, this morning there was an interview with former RBI Governor Duburi Subbarao on one of the TV channels, where this very same question was being asked about adequacy, and he talked about another metric which I was hearing for the first time, which is a very interesting metric, that forex reserves, how much do they form part of your GDP? And he said at the peak, when our reserves, India's reserves were at 600 plus 640 billion, it was 21% of GDP. But right now it has fallen to 17% of GDP, which is much better than what it was during taper tantrum. I believe it was 15% of GDP. So that was the former RBI governor. So he also said there is not too much reason to start feeling alarmed, but you should watch it for the next couple of months. And there is a Reuters poll which was released on Monday, which said its median results showed that forex could fall to about 523 billion at the end of this current financial year, and that would be enough for imports of 8.22 months, which was again the same thing which happened in 2012 and 13. And there is a danger mark. Can you tell us what is that danger mark and how it is calculated?
So it's all depends on what we are taking as the indicator, but these are what we just discussed. Those are the 3 metrics, and in addition, percent to GDP, danger mark would be somewhere, if it goes, forex reserves go below $500 billion with the current kind of a situation. Now there is going to be some rethinking about the strategy of intervention, and that we can always also see the early indications getting from the government that we should not now allow the forex to be used for preventing the rupee slide. Rupee should be allowed to be adjusted to market fundamental. So 2 things: one, where does the dollar go? What is the trajectory of the strength of the dollar? And secondly, what is the RBI strategy? That will determine the magnitude of forex reserves by the end of the year. So if US Fed keeps on increasing rates for some more time, which is what they have indicated through their projections. So on 21st of September, the latest Federal Reserve meeting was held. Along with increasing the rates by 75 basis points, they came up with these projections, which say that there is a scope for further increase in the rates by around 1 to 1.25% this year. Even next year, they are not going to start reducing rates. They may increase rates, and then maybe in the second half of the year, they may pause. So that is the indication as of now. So based on this, it is expected, it is likely that dollar will continue to increase, appreciate, and therefore the Reserve Bank of India needs to think of its instruments in its policy toolkit to think about rupee's strength and to think about forex reserves.
In fact, there was a report in one of the business papers this morning which said that the finance ministry is not in favor of selling dollars to defend the rupee, and you cannot fritter away reserves defending some artificial or imaginary rate of exchange. What is 80? What is 81? We discussed the last time. What is the difference between 79, 90 and 80?
80, yes. Yeah. Yesterday, rupee plunged to 81.94.
Yeah.
So we are seeing rupee plunging, and no crisis situation has emerged due to that. In fact, it will lead to some kind of bridging our current account deficit, because if exports become more competitive, it will have an impact on current account deficit.
Also, there is a view that if there is a global slowdown, as it looks like, or there already is a global slowdown, commodity prices will come down, which means your import bill will come down, which means your depletion will be much slower. That is also a hopeful suggestion. So let's take some questions, Radhika. We have a lot of questions from our viewers, very good, tough questions. And let's see what they want to know today. And the first question is from Aditya, a regular viewer. Hello Aditya, thanks for your questions and thanks for watching us regularly. Do you think simplifying taxes, especially the capital gains tax, can also make a positive impact on foreign investors and will lead to more foreign investment, thus leading to higher reserves?
As of now, the problem is not so much of taxation. As of now, the problem is firstly the dollar strength, and secondly the risk of sentiment by foreign investors. So till 2 years back, or till even the pandemic time, we were seeing our forex reserves getting accumulated because there was an inflow of both foreign direct investments and foreign portfolio investments. So reserves were piling up. But now we are seeing that on the one side we are spending reserves to arrest the rupee slide, and on the other side the pile up of reserves has slowed down because the markets have become much more volatile. So as of now, all those suggestions would be helpful in the medium term, but as of now it is mainly due to the dollar strength, and so long as the dollar will continue to become strong, there is going to be volatility, and emerging markets need to brace for that volatility.
The next question is from Raju, and he remembers what our former columnist and writer Dr. Ela Patnaik often spoke about. She was your co-author also. Dr. Ela Patnaik often spoke about the need for a functioning bond market and spoke about PDMA Act. Would that have helped with rupee stabilization, as capital could have come through that route? What is stopping us? Also, there was talk of listing of Indian government bonds on international indices. Why is that delayed?
So here the relevant part from here is the bond market. If we have more deep and liquid bond market, and if we address all the frictions that are associated with bond market, that will lead to more inflows of foreign investment. Right now we are seeing more inflows in the equity market, but in the rupee denominated bond market, which is what we talk about, there are problems. Foreign investors' participation in government bond is low by international standards. And so if we are able to address those frictions, which we have tried to do over the last 2-3 years, even in the month of July, the RBI eased a lot of restrictions on foreign investors' participation in government bonds. We spoke about that in the July episode. So we are seeing that improvement happening, and it will get an impetus once Indian bonds are included in the global bond indices, because that will lead to a massive inflow of passive funds, because those funds which are generally want to invest long term, and they just want to invest on the basis of the criteria that your bond is included as part of the index. So those will definitely get an impetus, and we would have an inflow of foreign capital with the inclusion of Indian government bonds in the bond index. We should hope for inclusion either by the end of this year or early next year. So that will definitely help in further boosting our capital account.
In fact, I want to add to that, Radhika, our colleague Shubham Batra had done a report it was an exclusive report on the 21st of September, just about a week back, that the government and the RBI have held talks with JP Morgan for their bond index. And the process of doing that has started, and it will take another 2 quarters before Indian bonds are included on this index, is what he had learned, because there's a lot of things that have to be sorted out behind the scenes before it actually happens. So 2 quarters would mean we are end of September, so by the end of the financial year.
By
the end of the financial year.
That is what, early next.
The next question is from Vishwa Pratap Singh. In 2013, the big central banks were only slowing the rate of injecting liquidity into their economies. Today, they are tightening by reducing money supply and raising interest rates. Still, India's situation is better than last time. Is it only because our forex reserves have more than doubled since 2013, or there are some other reasons as well?
There are definitely additional reasons, because in 2013, if you see India's macro fundamentals, we were grouped under fragile five. So our macro stabilization was not sound. Our fiscal deficit was very high. Our current account deficit was very high. Forex were low. So based on various economic fundamentals, also our inflation was very high. So as a result, we were part of the fragile five. And when the Federal Reserve Chair decided to indicated that they will start tapering the bond buying program, it's these fragile five economies that were majorly impacted, not the other economies. So at that time, the problem was not just of forex reserves and rupee exchange rate, but also our macro fundamentals, the macro variables which we commonly look at, those were also not in good position, and that's why we were more impacted by the crisis situation. At this time, our macro fundamentals, despite global headwinds, despite COVID, are much better. GDP, we are expecting 7%, at least 6.8 to 7%. Forex reserves are relatively fine. Our high frequency indicators are doing well. So it's not just the external vulnerability, but our macro fundamentals are much better this time. And that is the reason that we are faring much better this time.
In fact, Ruchir Sharma, who had talked about India being in the fragile five, I mean, he did not coin it, but at that point of time, there was this whole commentary. And now he says we are among the 7 wonders of the world. So from fragile five to 7 wonders, it's quite a leap. Sanjay Tiwari has the next question. Will trading in currencies other than the US dollar like rupee ruble, rupee taka, rupee real going to help India in any way to conserve forex reserves?
Definitely it will help, because that will help us in saving part of the dollars that we use for import payment. But it will take some time to finalize all the modalities of, say, rupee ruble trade. What will be the exchange rate, rupee taka, what will we do with other currencies?
Absolutely.
Because with Bangladesh, we are the net exporters. So we will have taka. So how that will be used. So all these things need to be firmed up before we can actually make this statement that will have an impact on our forex reserves. But definitely a good starting point has been made. And there are a lot of countries who are willing to buy this idea of payments in local currencies. So that should get a fillip going forward because of the relentless strength of the dollar.
The next question is from another very regular viewer, Hitesh Nautiyal. Hello, Hitesh. For attracting more forex reserves, what are the key steps that government must take and to ensure these reserves are also stable?
So it has to, what the government is already doing, it has to step up those initiatives. So to see what are the frictions in greater FDI inflows, because if we look at our accretion of foreign exchange reserves, what are foreign exchange reserves made of? We have foreign currency assets, we have special drawing rights, we have gold. So we have to, and foreign currency assets is constitute the bulk of our forex reserves, more than 80%. And that is coming from foreign direct investments, from export payments and so on. So we have to review the foreign direct investment rules, regulation, and see if there are some frictions. Though we are seeing considerable improvement in our FDI inflows, and the government has given this statement that this year we are well poised to achieve $100 billion of foreign direct investment. So all these things need to be streamlined. The other thing is free trade agreements, and also a review of with which countries we should have for free trade agreements, so that we benefit potentially the countries that are going to matter to the world. We should have FTAs with such countries. And the last point is easing the compliance burden and reducing the cost of doing business. So these will help in boosting our capital flows, and that will help in forex reserves.
Chanakya Bharat asks, why didn't the rupee gain when the Fed in the US printed money left and right during the pandemic, but the rupee is falling when the Fed is raising rates?
There is no such, we cannot talk about a one-on-one relation. That time when the Fed was injecting liquidity, what we were seeing is an inflow of foreign investments into emerging economies, including India, because the interest differential between Indian yields and US yields was rising, because US yields were falling at that time. They were following an ultra-accommodative monetary policy. So as a result, we were seeing an inflow. So we did benefit from that ultra-accommodative monetary policy, and our rupee exchange rate was also not a problem. And now it is happening because of what we've talked about in general about the rupee strength. So it's primarily due to the fact that the injection of liquidity led to an inflow of foreign investments into the economy, and also triggered domestic investments into the economy, because the markets were really rising, and markets were doing well during that time.
Last question from Vinayak Sardesai, and it's connected to inflows and stock markets. So he's saying the byproduct of too much of liquidity that was infused during the pandemic by Western economies was that stock markets scaled higher highs during 2020 and 2021. And now, since the liquidity is being sucked back from the system by raising rates, do you think the stock markets will slowly go back to pre-pandemic levels? I suspect he's referring to the Indian stock markets.
During 2020 and 21, because of the lowering of interest rates, we saw that bank deposits became a relatively unattractive investment option. Also, with work from home and impetus to digitization, we saw a lot of retail investor participation picking up in the stock market, and coupled with strong inflows from foreign investments, we saw equity markets booming. And companies also took advantage of this environment, and they did a lot of IPOs, fundraising programs during that time. So that was the situation till 2021. And now with the bond yields picking up, we are seeing some kind of a reallocation. For example, during 2020 and 21, a lot of companies accessed the equity market, because at that time the yields were lower. Now they are again moving to banks, because yields have risen much sharply as compared to bank rates. We will see some kind of reallocation in portfolio happening by retail investors, domestic investors as well. But it won't be like that there would be a concomitant fall, but there would be some reallocation of resources happening due to the changed dynamics.
Okay. Last point question from me, Radhika. So we should not be worried or alarmed by this gradual fall. And is it okay if forex reserves touch 523 billion by the end of the current financial year?
Yes, it's as of now, it is not a situation of an alarm, because we have adequate forex reserves, because we have adequate buffer. But going forward, 523, then 500, then 450, somewhere we need to rethink the strategy of aggressive intervention and letting the rupee slide, and only intervene when there are sharp swings or volatility in the rupee rate. But in normal set of circumstances, and normal here would mean rupee depreciation happening. So that should be allowed to fall and to be able to align with the market fundamentals.
Okay. At the moment, it is not an alarming situation, but aggressive intervention should be rethought as the forex reserves keep falling. And what is the level of the rupee should be left to the market.
Yes.
That's Radhika's summary on the shrinking forex reserves. Thank you so much for watching this episode of Macro Sutra. We will be back next week with another episode. Until then, stay safe and have a great weekend.